In the past, we've pulled out of certain markets when we felt that they were frothy. So we actually stopped lending in Toronto in 2016. Sorry, people from Toronto. And that was a big move for us. It was actually a time when we entered the Quebec market. So we do look at the different dynamics in the various markets and try to identify risks and opportunities and respond accordingly. But today there isn't any major city in Canada that we won't touch.
Okay, what about you, Rob?
So I'd say 96% of our book is either in the GTA or Vancouver, which we regard as the two most liquid markets in the country. And the other 4%, there would have been some redeeming reason to go there, and that probably would have been Hamilton or Ottawa or Kelowna. It would have been a fairly good-sized center as well. But, to be a good lender, you can't change your portfolio quickly. So you better be lending defensively when times are good, because situations like potentially could happen over the next 6 months happen so quickly, and you have an illiquid portfolio that you can't force repayments on. So you have to be consistent, and you have to be disciplined even when times are good. And so we've decided just really to focus on Ontario and BC, and more specifically on the GTA and Vancouver. And if that hurts our growth and we don't hit $1 billion, so be it.
Okay.
Oh, yes. So we're 2/3 of our portfolios within the GTA. The residual of our portfolios in Alberta and Quebec. We've been in and out of Alberta. We like the market dynamics in Alberta, particularly around the areas of enforcement. Quebec as well. We like Quebec. 99% of our portfolio is residential today. A small component of it's commercial. The markets that we don't go into are BC. We just don't understand the market dynamics out there. But that we're pretty much agnostic. But we will only focus on core markets within this country. So we won't do rural. We won't do suburban, if you will. And we always focus on, as we call it, liquidly marketable real estate. So real estate that if there was ever an issue and a downside or downturn scenario, we're able to sell it and liquidate it immediately and get our money back.
Okay. And what we haven't spoken about is really sectors and sort of lending into certain sectors. I'm going to start with you, Sandy. I know that you mentioned that you do construction loans.
Yes.
Again, inflation has creeped into construction prices.
Yes.
Does that make your loans riskier if you're lending out and then construction ends up being obviously higher than what was originally anticipated, or how do you protect against that?
So our focus, yes. So on all of our underwriting, we focus on what the cost will be. We map out what the cost will be on a construction project, and we adjust our loan to values accordingly. Obviously, given the rising rate environment, it's difficult to control construction costs. That said, on the resident, all of our loans are a year to 18 months fully open. So what's important there, or the vast majority of our loans, what's important there is that the vast majority of our loans are single-family homes. They can build the houses relatively quickly once they're permitted. They do their construction. The costs are relatively fixed at that point, and they can complete the project, and we can get our money back that way. If we commit to a condo loan, which is the biggest risk, given the fact that it takes years for permitting, titling, as well as then getting the construction off the ground, and that's where your cost creep can occur. Mm-hmm. The caveat that we have two caveats. One, the developer has a significant track record in development and is significantly capitalized. That's the first caveat. Second caveat is they have to build on spec. We're not in the business of allowing for a developer at this stage to go ahead and do pre-sales in advance of us having to wait years out for them to go out and build their project. They need to start building on spec today to control their costs, and then in that regard, we'll then advance funds on those types of projects.
Okay. Rob, do you have any sectors that you won't lend to? Like retail, for example, would you?
Retail, we have very little exposure, although
Yeah.
lending on King West or Queen West, where there's retail on the ground floor and apartments or office above, that's very liquid real estate. So
Okay.
we would do that all day long.
What about commercial or office? Commercial and office.
We're looking at office now, but we're being pretty careful. Like I don't think people realize, but in Toronto, the suburban office vacancy rate is 20%. And even before the pandemic, it was 12 to 13%. Downtown, as you probably know, was 2.6. I'd never seen that before in my career, nothing even close. And it's around 10% now, but I think there's a view that there's something special about downtown Toronto in terms of office. It's really interesting. In Vancouver, it's not that way at all. The vacancy rate in suburban and downtown Vancouver are virtually identical. And it's not viewed that in order to recruit young people, you have to have an office downtown, which is why Microsoft is coming from Mississauga down to CIBC's new tower.
Okay. Talk to me a little bit about timing. Do you think that this is the right time to invest in mortgage funds, or should we be waiting until the rate hikes have impacted the rates or yields? Lisa, maybe you can answer that question.
Sure. Well, our fund is designed to perform through any market cycle. So that's why we toggle things like loan to value so that we take risk off. Another lever for us is leverage. When we reduce our leverage, it can have a negative impact on returns, or it should. But that means that we're sort of preparing for some market volatility should it occur. I think that there could be a liquidity dry up in the market as banks raise their rates. It leaves less room for borrowers to move up the credit spectrum, which is often the exit strategy for them when they borrow from us for, say, 1 year at a time. So that can create some risk in the market for sure, and that's why we do things like limit LTV or reduce leverage, but that also creates an opportunity. So for us, and other mortgage funds, if you're able to provide financing at a time when borrowers have other limited options, that provides an opportunity, a great opportunity for you to deploy capital. So is it a good time? Yes, I mean, I have my money in our mortgage fund, so I'd like to say yes. I think you have to be aware of the risks and understand that there could be some volatility in the real estate markets, and just invest with a team that you trust, and somewhere where you understand how what their strategy is to move through this period of uncertainty.
Okay, and Rob, you've got a very long-standing fund. What kind of environment would you liken this one to in the history of your fund, and what was really the reaction at that time?
I don't know if, I mean, this is not 92.
Yeah.
There you had no foundation of strength in real estate. You had pension funds that might have owned 2% of their total book in real estate. The REITs were actually created as a result of the illiquidity in 92. So the foundation is so much stronger. The leverage is so much less. It was really sexy to leverage to 75% in the early 90s. In fact, you weren't part of the group if you didn't do it. And you had negative leverage. So it's not at all like 92. But the pandemic was really short in terms of its negative effect on real estate. And honestly, so was 08, 09. I just found the market sort of froze for a year. Nothing really bad was happening. No transactions were happening. And then the market revived itself. And actually, some players did better as a result of what happened in 08, 09. Very different from the States. So I don't know what I would compare it to, but it's interesting. It's the first time in a long time we've seen rising rates. What's hard to remember is that overnight rate, the Bank of Canada overnight rate, is still below what it was pre-pandemic. I can't believe it when I think of that, because everybody's so terrified of these rate increases. But the fear is it goes well beyond where it was before the pandemic.
Okay, would you agree with that, Sandy? Is this, with Rob's comments, have you seen this kind of period before, or would you liken it to a period in the past?
Yeah, I would, actually, I diverge slightly from Rob's comment in that what we're seeing right now is a rise in interest rates, but we haven't seen, for example, on the commercial side, a rise in cap rates yet to offset that. And that causes obviously some concern. And to put it in context, we're still seeing residential people buying apartments at 3 caps today when they're financing at 3.5 to 4. So obviously you're coming, and you're doing this in Ontario of all places, which is heavily rent regulated. You know, I understand if you want to do that in the U.S. in a place like the Sun Belt, like Texas, where you can move rents to market pretty rapidly. It's very difficult to do in Ontario. We're seeing one end of the curve, you know, in the sense that you're in this rising rate environment, but you haven't seen cap rates move in lockstep. So, but that being said, where you want to play today, and getting back to your original question, is obviously, I think, be a bond holder or a debt holder as opposed to an equity holder. In particular, you want to play the short end of the curve today as opposed to the long end, because you'll be rewarded with the short end rising over time as you will versus the long end of the curve today. So if you're going to invest anywhere, obviously invest your capital, obviously with mortgage providers that have not only a great track record of investing, but have also seen these downturns, if you will, and been able to manage their way through it. But more importantly, playing the short end of the curve, I believe, is very critical today, as opposed to playing the long end. Because if you play the long end and you're in a highly inflationary environment, you will get burned over the long term.
Okay.
I think there's going to be more distinction in the cap rates. Let me give you an example. If you're buying an industrial building where the rents have been on the books, the lease rate has been on the books for 3-4 years, you may double your renewal.
Yeah.
There I can see a 4 cap, 3.5 cap.
Understood.
Same thing with an apartment building. There aren't a heck of a lot of them left, but some apartment buildings do have big upside. Not sometimes as big as promoters make them out to be, but big enough.
Yeah.
So you can actually make sense of the cap rate, a low cap rate there. But in a hot market, which is what we've had, I always find the difference between a very mediocre deal and a sensational deal narrows in terms of the cap rate, and it widens when the market softens and investors aren't quite so anxious to buy the next piece of real estate.
Okay. When I'm thinking about mortgage funds, should I be thinking about it as part of my fixed income piece of my portfolio, or should I be really thinking about it as a safer portion of my real estate portfolio? And I'll leave that to anyone on the panel to answer as a money manager.
I would say fixed income, because we're only lending at 60% loan to value, so
Yeah.
we're a high yield fixed income vehicle, in my opinion.
Yeah, I would argue it's fixed income. I mean, there's a lot of portfolio managers that argue that it's alternative investing, and particularly at the banks, and they put it in this group that, as being high risk with the big, death sign on it, if you will, right? And I think that's wrong. It's true though. I mean, you see it particularly in portfolio management today at the banks, where if I show up as a client off the street and I have, $50,000 to invest, the advisor puts me in either portfolio A, B, C, or D, depending on certain criteria. It's box investing, as I call it. And the reality is, it should be deemed to be fixed income in a similar vein as buying a Canadian bond, provided, of course, that the person or the group that you're investing with have that track record of being able to lend, to deal with crises, to deal with, a collapse in the underlying, or a collapse in the mortgage itself, and being able to enforce and willing to enforce. That's what's critical, right? So you can't put everyone in the same brush, if you will. So that being said, I would argue that it is fixed income, to Rob's point.
Okay. And so we're talking about riskiness, we're talking about protection with loan to value in the different sectors. What about personal guarantees? Do you take personal guarantees on the mortgages? Do all three of you
Yes.
do that? Okay.
Yes.
And I think we talked about it. Have you had to exercise on personal guarantees before?
Occasionally.
Hopefully not. Rob?
Yeah, not often. I mean,
Okay.
what it usually does is keep the borrower focused on the real estate,
Yeah.
really focused on the real estate.
Okay. Let's talk about where you get your mortgages from. Are they through mortgage brokers, or do you have your own team? And maybe we'll start with Lisa.
Sure. So we source all of our mortgages through the broker network. As I mentioned, we're based in Vancouver, but we have broker relationships across Canada in any city that we operate in.